What's going on, guys? My name is Daniel. I'm a real estate entrepreneur and also author of this book right here, 0 to 75 Units in 1 Year. And in this video, we're going to talk about how to analyze real estate deals the right way. Now, the reason why I say the right way is because, well, I've been around the block and seeing kind of what's out there in terms of books that teach you how to underwrite and analyze deals. I've listened to a lot of podcasts, read a lot of books, and have seen a lot of things, especially in the online platform. And well, a lot of people, when it comes to analyzing deals, talk about how to run the numbers, right? How do we calculate the cash flow? And while that's not a bad thing, there's a lot of things, in my opinion, that are missing from that underwriting model. And again, I'm not saying those individuals who teach you this are bad people or they're not good at real estate. You know, they have as much experience, if not more, than someone like me. And by the way, guys, my experience is that by the time I was 23, I had 87 rental doors. And today I'm 27. I'm the founder and CIO of Miati Partners Capital, which is an institutionalized, diversified real estate fund. So one more thing, at the end of the video, I'm gonna gift you guys 2 things in the spirit of Christmas that you guys will be able to do to continue learning even beyond this video. Okay, so when it comes to analyzing real estate deals the right way, I'm gonna share with you guys 2 things that I've used that really has helped me analyze and understand the deal from every single aspect and every single angle. That way it can mitigate the risk for you and make as much money for you and also your family. Now, those 2 things that I'm gonna share with you are the 6-pack method and also the financial quadrant strategy. So with that said, let's go ahead and get right into it. Now, I'm gonna go ahead and first start off with the 6-pack method. Now, the 6-pack method looks a lot like this. Now, you have to excuse me, I'm not much of an artist, but when it comes to the 6-pack, it's got 6 different quadrants. Now, these 6 different quadrants represent different things. On the left side here, we have risk. And on the right side here, we have reward. And in the left side, we have what's known as the property. We have place. And we also have person. Now, these 3 P I refer to as the PPP. Now, it's not the Paycheck Protection Program, but it actually represents property, place, and person. And it's just this idea and concept that every single deal involves a property and every single deal involves a person. Now, the problem that I personally have with how underwriting and analyzing real estate deals are taught across different platforms and across different gurus is everybody focuses right here. This is where they focus all their energy. And you know what this quadrant's all about? It's all about calculating the cash flow. Yeah, right? We want to talk about how much money we're going to make. Why? Well, I get it. It's because it's sexy and we all want to know how much money we're going to make. We don't want to talk about the downside and the risks and how much money we might lose, even though most people find out and it's too late. But for the most part, every single guru and podcasts and books that I read, they only talk about this quadrant right here, which is, hey, what is the reward side of the property? Now, all these spaces represent different things. Obviously, the reward portion of property represents the cash flow, how much money that we're gonna make. And by the way, guys, with the financial quadrant, which is the second thing that we're gonna talk about here in this video, I'm gonna talk to you how to get this number even more accurately than how other individuals may be teaching you on YouTube. So in the risk side of the property, what we have to talk about, well, what are the negatives? As in, what are the negatives associated with the actual property itself, such as, the inspection report that came back and there's some structural damages. Maybe there's about $5,000 to $10,000 worth of deferred maintenance that we have to do. Maybe the porch has to be redone. That's what I'm talking about when it comes to the risks associated with the property and also the numbers. So for example, one of the most common red flags and common risks of underwriting the property is running your numbers off the offering memorandum or the sales brochure. Now, I have a huge problem with that because in most situations, you find a property on the MLS or on the market, or maybe it's on Zillow. Let's say it's a 6-unit property. The commercial broker is going to put together an offering memorandum, and it's going to talk about the market. It's going to talk about this. It's going to talk about that. Which, by the way, do you ever find it funny that there's absolutely no negatives? And if there is, it's very quickly turned by, hey, but there's a positive again, right? It's always talking about why you should do it and how awesome it is. And I get it, right? The broker's job is to have you buy the property. And by the way, it's not for you to just buy the property. It's for you to buy it as high of a price as you possibly can. Does this help you? Yes or no? It doesn't, which is why I don't like running the numbers off of the offering memorandum, because 90% of the time, the numbers on the offering memorandum versus what I actually see are two completely different things. Now, I've looked at a lot of offering memorandums in my day, right? And I'm not saying brokers are bad people. I'm not saying that they're lying to you. You know, I've had some of the greatest experiences buying pieces of real estate through brokers. I have my personal favorites that I work with, and they're amazing. Which, by the way, shout out to my good friend Ralph in Brevard County. Love you, man. But when it comes to running the numbers in the offering memorandum, on average, out of all the ones I've seen, the expenses tend to be around 35 to 40% of the entire gross income. Whereas if you look at a more accurate document like a Schedule E or Form 8825, which, by the way, guys, those are the official income and expense reporting forms reported to the IRS, which, by the way, those are the documents that I like to ask for from the seller. Because why? Because think about it, they're a lot more honest. The goal of a CPA is to make sure that there's as much expenses as you possibly can pile on there. Because why? It's going to help you with your taxes. Now, I don't know about you, but I want to negotiate and I want to work my numbers off the document that has all the expenses on it, as opposed to the document where, hey, maybe we hide some of these expenses so we can make the purchase price seem a little bit more justifiable and this property seem a little bit better. Meaning that if I negotiate it off of the Schedule E or the Form 8825, guess what? I'm able to get a lower price because the income is lower. The income is lower, the price is lower. The price is higher, the income is higher. And by the way, guys, in 2020, the average expense ratio, which is the expenses compared to the gross income, the average expense ratio for a B-class or a C-class apartment complex, meaning that it's kind of in the middle, right? It's not in the worst parts of town, but it's also not in the best parts of town. The ones right in the middle, they tend to have around a 47% expense ratio, meaning that on average, your expenses are going to be 47% of your gross income. And expenses include stuff like, utilities, taxes, maintenance, insurance, et cetera, et cetera, et cetera. So for me, that's the risk. That's one of the biggest risks of running numbers for a property is, hey, are these numbers that I'm utilizing to calculate my cash flow and my rate of return, are they the right numbers? Have they been verified? Are these true? Is this exactly what I'm going to see within the first 12 to 18 months of me owning this property, right? And again, we have to verify, we have to underwrite these things very carefully with a lot of detail, because it's our money that we're talking about here. Or in some cases, our investors' money, in which that case, we got to be even more protective and even more careful. Okay, going down to place, we have to look at the reward and also the risks. A great example of a risk for a place, which, by the way, is just another word for, well, what market is this building located in? So for example, if this 6-unit or 8-unit property that we're looking at is located in my home state of Illinois, well, that's a risk because Illinois has a population decrease. Right? There are more people leaving the state of Illinois as opposed to entering the state of Illinois. And that could be said of, states like California, New York, and guys, I'm not trying to make it political here, but states like Texas and Florida and Tennessee and the Carolinas, well, they're seeing, and also Arizona, right? And Idaho, they're seeing huge increases in population. So that's also could be a reward, right? A population increase. Another risk that I like to stay away from is if the place that I'm, the town or the county that I'm investing in, if they have one employer that tends to employ more than 25% of the population, well, for me, that's kind of a red flag and that's a big risk because, well, what happens if that employer were to move out? What if they were to go to another place? Especially if that employer, if that big industry is located in a state like California or Illinois, where a lot of businesses have been leaving. Where we saw guys like, Elon Musk leaving, California for Austin. And I can tell you for a fact, living in Illinois, I saw a lot of companies move out the last 3 to 5 years and move to more business-friendly states like Florida and Texas and Tennessee. So that could also be a potential risk, right? Big employer. Another thing that we have to look at is also, the amount of jobs, wages, that could potentially be a benefit or it could be a risk, right? So I'm gonna go ahead and put that on that side as well. Now, another big thing that people tend to look at is rental trends, as in, is this an area where rents are going up or are rents going down? Now, let me tell you why in early 2022 and late 2021, that number might be a little interesting to look at. Now, I have a theory that because the housing market has been so hot the last 12 to 18 months, it's actually pushed a lot of individuals into the rental market. And not only that, because you had a lot of individuals who are kind of in transition of they're selling their house and they're wanting to move to somewhere somewhere smaller and downsize a little bit, and they need that 3 to 6 month time to live in an apartment or rent during that transition. And by the way, we've got record number of individuals who are in transitionary leases like that, like the 3 to 6 to 9 month leases. That number has actually never been higher than what it is today. So because for that reason, you have a lot of individual staying in the rental market, perhaps temporarily. A lot of individuals who are on the sidelines of the housing market wanting to buy their first home, well, they're still renting. So because all that demand, it may produce a temporary increase in rents. And within the next 2-3 years, we actually might see rents possibly even go down or sustain itself. Whereas a lot of companies like Zillow and Realtor.com and Redfin are actually predicting a 7 to 15% increase in rent over the next 2 to 3 years. So again, my thesis and my MO is question everything. Verify every single number and make sure it makes sense in the overall arc of what deal that you are currently doing. Now, most people stop here, right? I always say the amateurs stop here, the good investors stop here. The experts, in my opinion, the guys who have been doing this for a long time and have seen amazing results, continue on to this space, which is the person. Every deal involves a person. And yes, there is a risk and reward associated with who you're doing business with, right? And when we're talking about the seller, we're talking about, individuals on your team. It could be a broker, right? Et cetera, et cetera, et cetera. Guys, I've had deals where the broker, the middleman, was a risk, a huge risk in my deal, right? As in I'm trying to, do a seller financing deal and the broker's trying to talk them out of it because they're worried about protecting their commission. And because of it, they're not, putting the best interest of the seller in mind. I've had situations where the seller was just a total nightmare to work with. They didn't want to, negotiate. They weren't willing to be reasonable with me. They weren't willing to, hey, if I were to do this for you, could you do this for me? Could we have some give and take here? I've had sellers, guys, where all they wanted to do was just take and they never wanted to give. So this might cause a potential risk, and it might actually even cause a concern for not even doing the deal at all. I can tell you guys multiple scenarios. The deal was phenomenal, but because the individual was not a good person, they were a bad person, they were hiding a lot of things, I just chose to walk away from the deal, even though the cash flow was phenomenal, even though we were buying it maybe under purchase price, maybe if had some great perks, I chose not to do it because the individual who I was working with. Whereas there may be other aspects where the seller is actually a benefit, or the broker is a benefit, or the team is a benefit. Not a lot of people do this enough to where, hey, if I buy this 8-unit building, how's my maintenance guy? How's my attorney? How's my, repairman? How's my plumber? How's my this? And, is that slot even filled? Do I even have individuals on my team right now that could, do maintenance or do this or do that? Do I have a backup cleaning lady, right? That's going to be a risk. And it's up to you as a real estate entrepreneur to turn these risks into a reward, or even at the minimum, learn how to mitigate them. Now, for me, my favorite way of, meeting maintenance guys, repair guys, contractors is through referral. There's been very few times where I've Googled somebody and I've had a great experience. Typically what I like to do is I like to ask the individuals, even if I'm investing out of state. So for a lot of you guys that are wanting to invest out of state, one of the things that I'll do is, I'll go on like meetup.com and I'll find my equivalent in that, in that market, my counterpart in that market, somebody who, maybe does a lot of local meetups, maybe somebody who does, a lot of real estate in that area. I'll call them up, I'll email them, I'll say, hey, John, right? My name is Daniel. I'm looking to buy some properties in the area. Would you recommend a good contractor or a good maintenance guy? And a lot of times, if these individuals have a good contractor, they love referring that contractor out to other individuals because they want that contractor to stay busy. They want them to get good business and continue to get good business as opposed to somebody who may not be as good, right? So there could be risks and reward associated with the person, the place, and the property. And as a matter of fact, all the coaching clients that I work with one-on-one, every single deal that they do, I make sure they fill out every single quadrant. And we get deep into each one of these boxes because any single one of these things could potentially ruin the deal. It could cause a lot of risk. And worse yet, it could cost you tens or maybe even hundreds of thousands of dollars. Whereas if we're talking about the rewards, unless we identify them and unless we go deep, we may not be able to capitalize on them. That's the key thing, guys. We want to mitigate here and we want to make sure we do a great job capitalizing here. Now, having said that, let's go ahead and talk about the financial quadrant, right? So I want to talk about this space a little bit and how I do it a little differently. Now, there's a very famous thing out there called the 4 ways to make money in real estate. And that's what I use and go off of when I talk about my financial quadrant method. So the 4 ways to making money in real estate are very simple. On this side, we have the cash flow. On this side, we have the principal. On this side, we have depreciation. And on this side, we have appreciation. And these are the ways that we make money in real estate. So for example, let's say that we've got a deal here. Let's say, it's a 6-unit building. Let's say that, we have a 50% expense ratio, meaning that out of the total gross income, half of it is going to go towards the expenses. And again, example of expenses could be taxes, insurance, maintenance, utilities, repairs, et cetera, right? And let's say we get some financing of, 20% down, 4% interest, 25-year amortization. And let's say that for the sake of the example, I'm just doing cowboy math here, guys. Each unit rents out for $1,000 a pop. Now here, we're gonna calculate what the income's gonna be. So very simple, guys. We have 6 units. We multiply that by $1,000. That's $6,000. We multiply that by 12. We get $72,000. That's what's known as our gross income. So the money that we make gross every single year is $72,000. Now, because we know half of it is going to go towards expenses, our net income, aka our NOI, our net operating income, one of the most important numbers to know in real estate, is going to be half, which half of 72 is 36. So we know our net operating income is $36,000. So with that said, we got to calculate now our cash flow. What could our cash flow be? Now, obviously, the formula to calculate cash flow is your gross income minus expenses and minus debt service. That's what's going to give us our cash flow. And that cash flow number, well, that's the money that we take home, right? That's the money that goes to put the food on the table for our kids, clothes on the kids' back, and pay their tuition, right? Maybe a vacation or something like that. That's the money that we actually can take home and save or spend, right? So in order for us to calculate our cash flow, we got to get our debt service. Now, in order for us to calculate our debt service, well, we got to go ahead and get our purchase price, because without our purchase price, these terms don't mean anything. So let's go ahead and get our mortgage calculator. Now, in order for us to calculate our mortgage, obviously we have to know how much are we buying this property for. So again, just using cowboy math, let's go ahead and say that, this property is being sold at what's known as a 10% cap rate. Now, by the way, guys, if you don't know what cap rate is, it's short for capitalization rate, and it's the number that describes the relationship between a property's net income and its purchase price. And the cap rate formula is very simple. It's cap rate equals NOI divided by purchase price. Very simple. Meaning that if the purchase price is $1 million and the net operating income is $100,000, the cap rate is 10%, right? Simple. 0.1 translate to a percentage rate, it's 10%. Okay, so in this scenario, we know that our NOI is $36,000. And we know that our purchase cap rate is 10%. So doing the simple math, following the equation that was just on the screen, we're gonna go ahead and say that the purchase price is $360,000, right? Because if we do the math, price $360,000 divided by NOI, which is $36,000, gives us 10%, 0.1, 10% cap rate. Okay, so calculating our cash flow, we now know what the property value is. It's $360,000. We got our down payment of 20% right here. We have 4% interest, and we have 25-year amortization. That's going to give us a monthly debt service, monthly mortgage of $1,520.17. Now, if I make that an annual number, so I go to my calculator right here, and by the way, if you want to follow along at home, you're more than welcome to do so. We're going to go ahead and put in $1,520.17, multiply that by 12. That's going to give us an annual debt service of $18,242.04. $18,242.04. Now, if we subtract that from our net operating income, that gives us a number of $17,757.96. And that, ladies and gentlemen, is our cash flow. That's the number that we're taking home every single day. But of course, we can't just stop there. We got to talk about our principal as well, because since we have a commercial mortgage, since we have a loan, and we're accumulating principal every single year, well, let's go ahead and see what that is. Now, if you have a mortgage calculator, which by the way, I would recommend Carl's mortgage calculator. I'm not being sponsored. There's no financial association with them. I just like using it because it's just super simple. You can use it in a Samsung, or you can use it in that inferior device called Apple. It works with any single phone. All right, so if we go to the table, it will tell us how much principal we're paying down for that first year. Now, I put my start date at January 1st of 2022 for my mortgage, and it tells me that in the year 2022, I'm paying $6,846.66. Now, the beauty of real estate is that if you buy leverage, meaning you go to a bank or you do seller financing, you're guaranteed to pay more principal as more the note season. So the longer you have the note, the longer you own the property, the more you're going to pay in principal each year. So for example, if I go 10 years later to 2032, I'm paying $10,207.22, which by the way is more than $4,000 more than I was paying 10 years before. So meaning I'm getting $4,000 more in principal that year than 2022. So that's the number we have for principal. Now, fun fact, if you combine this number right here, this cash flow number, and this number right here for 2022, and you divide it by your initial investment of the down payment, which is 20% of this, which is going to be $72,000. And let me verify that for you just to make sure that that's what the down payment is. Yep, the down payment is $72,000. If you divide it by that investment right there, that's what's going to give you what's known as the internal rate of return, which is you take the amount of principal you pay off and the amount of money you made that year, and you divide it by your initial investment. Now, if you want to come up with your cash on cash return, you take this number, which is your yearly cash flow, and you divide it by 72,000, which is your investment that you made for this property to obtain this property. But of course, we don't stop just there. There are also tax benefits of investing in real estate and owning rental properties. Now, here's the thing, guys. Please remember this. When it comes to owning real estate, you can depreciate the building, but you cannot depreciate the land. Now, let me stop there and tell you that, guys, I'm not a licensed CPA. I'm not a tax professional. Please consult your CPA and tax professional when it comes to the depreciation of your rental property. Now, we have what's known as the building to land assessment ratio. And simply what that is out of that purchase price of $360,000, well, how much of it was for the building and how much of it was for the land, right? Because obviously when we're buying a piece of real estate, we're not just buying the building, we're also buying the land that that building stands on. Now that ratio is going to look very differently for all across different deals. You may have a 6-unit apartment complex that sits on 20 acres of land, or you may have a 12-unit apartment complex that doesn't really sit on much land, right? Which is why I'd say it's going to be different. So the building to land assessment ratio is how much of it are you paying for the building, how much of it are you paying for the land. Now, my rule of thumb is typically 80% is building, 20% is land. So again, 80% of it is building, 20% of it is land. So when I'm taking my purchase price of $360,000 and I multiply that by 80%, that's going to give me $288,000. And what I'm going to do is I'm going to go ahead and divide that number by 27.5. Now, Why would I divide it by 27.5? Such a random number, right? Now, we mentioned this number in part 3 in the last video when we talked about buying properties, no money down or no credit, right? How to find deals that require no money down or no credit. Now, we say 27.5 is because that's the cycle, that's the depreciation schedule that the IRS allows. So the IRS allows us to depreciate this building right here for 27.5 years. So we want to find out how much depreciation we're given every single year. So we're going to go ahead and divide that number by 27.5. And that's going to give us $10,472.72. That is what's known as our straight line depreciation. Now there's other things you can do like cost segregation and accelerated depreciation, but in terms of the annual depreciation, to make things simple, it's $10,472.72 you get in tax benefits. And last but not least, we have appreciation. Now, appreciation is not when you admire somebody or when you compliment somebody and say that, hey, I appreciate you, which by the way, if you are a YouTube subscriber, thank you for subscribing. I appreciate you, right? But when it comes to appreciation, when it comes to real estate, we have 4 different ways of appreciating, and I'm going to show you what they are right now. First and foremost, we have what's known as passive appreciation. Then we have forced, and then we have phased, and last but not least, earned appreciation. Now, let me go down the list on what each of these mean. So passive appreciation is the most common, most popular form of appreciation. That's when you buy a property and 30 years later, it's worth more. And it's what our good friend Peter Schiff says, hey, this is inflationary, right? The price didn't go up, it actually inflated. So passive is when a property through time increases in value. Forced appreciation is when you increase the value of a property by increasing its income. Now, the biggest myth is that you can only increase the value of real estate and it's out of your control, right? But the fact of the matter is you can control the value of your real estate by changing things on your own. So forced is something that a lot of people are doing right now, where they buy a distressed piece of real estate, they fix it up, they increase the rent, and because you increase the income, you also increase the value. Now, phased is when you buy a property and because of external forces that happen in that local market, it increases the value of that property as well. So I'll give you a perfect example. I own a 4-unit in a little town called Moni, Illinois. Now, it just so happens that 2 years after I bought that 4-unit in Moni, Amazon put one of their largest distribution centers in the entire state of Illinois 2 minutes from where my 4-unit was located. And as a matter of fact, I think it was like the second largest distribution center in Illinois, and it was in Moni, Illinois, of all places, right? 2 minutes from where the 4-unit was located. Now, obviously, because that happened, my 4-unit is worth a lot more. Now, another really common way of phased depreciation happening is when you buy a house on one block and somebody comes in and they flip 6 properties on that same block, and because of it, the properties are worth a lot more. Now, because it's worth a lot more, it increases obviously the other houses in that neighborhood, the value of the other houses in that neighborhood. So that's how phased appreciation works. And last but not least, we have earned appreciation, which earned appreciation happens when you obtain equity by purchasing a property a lot lower than what it's valued at. So for example, if you have an apartment complex that's valued at $4 million and you buy it for $3.5 million, well, you have $500,000 worth of earned appreciation. So with that said, guys, I encourage you to try it out, right? Go ahead and draw up some numbers for yourself, or go to Zillow or Redfin or LoopNet, find a deal and try to do this financial quadrant with the deal that you find. Now, if you want to be super ambitious and you want extra credit, go ahead and do it not only with the financial quadrant, but also do it with the 6-pack method as well. And just practice and rehearse and get some repetitions in for different deals that you're going to find. I remember, guys, when I first started my real estate investing career, I would do this and also run numbers on the financial quadrant on a deal every single day, just to practice underwriting and analyzing the deal. Now, I never went after those deals, but I would still practice. It wasn't until I started raising capital that I was able to go after these deals, because all of a sudden I was recruiting and attracting different investors to go after these deals with me. Now, with that said, guys, I'm very excited to share with you that this is not the end. Although this is part 4 in the last video of this series, I want to give you guys some things that's going to continue your learning journey. First and foremost, I want to give you this book for free. You're going to check out a link in the description below. It's 0to75units.com. All you got to do, guys, is just put in your mailing address. Now, you are going to have to pay for shipping, but it's not that expensive. I'm going to give you the book for free. And in this book, we talk about all sorts of different things. And on top of that, I want to give you guys an hour free webinar, and I'm going to be going over in that hour how to raise capital. And as a matter of fact, I'm going to share with you guys all my secrets and techniques that I use to raise millions of dollars worth of capital to be able to go after real estate deals. So between the book and also the free webinar, both links are in the description below. Go ahead and check them out. Now, guys, if you've enjoyed this series, if you enjoyed this video, please subscribe to our YouTube channel. And if you're feeling extra generous, go ahead and smash that like button as well. And leave a comment. Give us some feedback. What are some things that you would like to have been covered? What are some things you would like to learn about? Maybe we'll do another series next year. So with that said, thank you guys so much. Get the book. I'll see you in the webinar. And until then, I'll see you also in the next video as well.